And we're going live. Well, hi everyone. My name is Matt, and welcome to another Market Intelligence Episode 3. We have to apologise in advance purely because of the fact we missed Episode 3 last week due to a little bit of scheduling problems. But hopefully we should be back on track from this week forward. What Market Intelligence TV is just myself, a former recruiter, now turned researcher for the last five years, just dissecting the market from a fundamental and macroeconomic perspective. I'm very interested in data and finding patterns, and yeah, this is essentially a fun project that I've created with a very special individual called Imre. Imre, if you'd like to introduce yourself very quickly before we start.
Yeah, cheers. Thanks, Matt. Happy to join you again. So my name is Imre. I'm trader, portfolio manager on the institutional side of things, as a lot of retail traders would call that side of the pond. So I trade with a legendary Wall Street currency trader named Andy Krieger, and together we manage a fund. We're primarily options-based traders. We trade spot as well. Just delighted to bring whatever experience I have to this conversation, and looking forward to it. We got a lot to talk about today.
Yeah, definitely plenty to talk about this week. So yeah, let's get started. I mean, this week in terms of economic data overall, there hasn't been much from just pure numbers perspective, purely because we are still in US government shutdown. As we all know, the US data is still the most important out there on the market, which essentially means we're stuck between essentially guess mode, right? What's going to come out within the next couple of weeks in terms of numbers, both from NFP, CPI perspective and employment perspective as well. And essentially, what we have to do is follow the European data and wherever a special individual tweets every now and then, and follow the dynamics of the market until we get a little bit of a resolution, hopefully coming soon, which will hopefully ease some people. But starting on Monday, the only thing that was of any importance was really the Chinese numbers that came out in terms of imports and exports. They all came out really positive, especially on the import side. I looked into the imports data because that spike was really incredible. I haven't seen that kind of spike in multiple years. I believe it was 4 or 5 in terms of versus the consensus and what actually came out on the market. And essentially, it was a lot of minerals and metals, essentially. China's collecting from gold to oil to rare earths like cobalt, nickel, basically anything they can get their hands on in terms of imports. And then, exporting has been extremely weak over the last, I'd say, 2 years from China. And right now the numbers are slowly starting to pick up. I believe that comes from the EV market, especially BYD has done a lot of exports to the West, especially the UK. So yeah, that's where the numbers are a little bit stronger than they should be. And in terms of trade balance, no shock there. The prices are starting to fall in some areas, especially within manufacturing and electronics side. So yeah, in regards to trade balance, it's slightly dropped, and also because obviously the imports have increased pretty substantially over the last couple of months. I mean, have you seen anything coming from China in terms of imports, exports at all, Imre?
Yeah, I think you covered that beautifully, Matt. It's frankly a very shocking number. I mean, how real the number is always something that's on the back of one's mind when considering things coming out of China. But What this highlights for me is the simultaneous, I would argue, decline economically and in terms of geopolitical strength of the US, mirrored by China's rise. And this rise is really interesting because China has a problem which simply cannot be overcome, and that is their population pyramid, their demographic structure is inverted, meaning that they have very few young Chinese coming up through the ranks
Yeah.
because they aren't making enough Chinese babies. And you have this rapidly aging population. That is a demographic problem that simply has no solution. And another thing I want to point out is that getting residency, being able to live in China is one thing. Getting Chinese citizenship is tremendously difficult. And that's because the Chinese have a very nationalistic policy. They're not alone by any means in the world, but they have a very
Yeah.
nationalistic policy around who they give citizenship to. And basically, you got to be Chinese.
Yeah.
So to combat this demographic problem, one thing, and there is a fascinating interview with, I want to say it was a senior executive from Ford, might have even been their CEO, but a number of senior executives, particularly in the auto sector, have been touring China's factories, and they are blown away by the level of automation that is taking place. And when I say that the demographic problem doesn't have a solution, yes, that's true. But automation does a lot to mitigate that issue in terms of helping out a workforce that is desperately going to need more bodies if China wants to continue its economic ascent to challenge for eventual superpower status. This automation advantage is tremendous. It should not be ignored, and it makes the rest of the world, frankly, look outright silly. It's downright embarrassing for America, and it's utterly humiliating for other Western countries like the UK. The UK is an absolute joke when it comes to manufacturing, relative to China, especially already. And
Yeah.
it's things like this technological advancement, which is progressing at such a rapid pace that cannot be ignored. So think whatever you will about the numbers, but one thing that the U.S. administration is making quite clear is that they are at war with China. Right now, it's an
Yeah.
economic war.
Yeah, yeah, no, I agree. And both countries right now are trying to get the edge and to mimic what you've said about the UK. Listen, I've done at the start of my career a lot of engineering recruitment. So one of the key things, I was going into a lot of the machine shops, and some of the machine shops were producing parts for Rolls-Royce, Boeing, Lockheed Martin, and extremely important parts. Fuel chargers and wings and engines. The for example, at the time I think it was the Trent 7000 series or 9000 series. Top of the line engines. For Boeing aircraft, and you go into those machine shops, and it felt like you were teleported back to the 1980s. It was insane. Everything was manual. Occasionally, you had a semi-automated CNC machine, but yeah, it sort of shows that the vast expansion in technology when it comes to automation and robotics. Yeah, China's king right now, and it just clearly shows. And I think I think they know they can't combat the demographic decline as much because obviously of the rising costs and the policy that precluded China for some multiple decades. The one child China policy that everyone knows about. Yeah, right now they're in that decline. Same as Japan, same as South Korea, and they're all in essentially demographic decline. And I think China's leading the way, and Japan, to be fair, in terms of saying, okay, we can't fight the population decline as much as we want to, so let's introduce as much automation as we can to combat this, or promote AI. You build more AI
Yep.
agents to mitigate that, which it's working. We're seeing it. I just don't know the long term impact, and that's something that we can discuss as we get into the Nasdaq and S&P later on with some of the valuations. But Yeah, Monday was pretty much dead. Otherwise, you know, there was Columbus Day, so the markets were relatively quiet in terms of data. But we'll go into the actual charts. You know what happened on the Monday because yeah, yikes, it wasn't pretty at all. On Tuesday, again, nothing really important from the data perspective that I saw. Everything was pretty much in line, and I've expected. The only thing that obviously was interesting from the UK was the fact that obviously unemployment rate has gone up ever so slightly to 4.8%. Yeah, UK has a massive problem. Recently, you know, Rachel Reeves, who is the UK treasurer, basically you can think of a, yeah, it's kind of like Hassett in a way. Um, yeah, yeah, basically a Hassett in the US, and she's essentially saying that she wants to introduce higher taxes for the wealthy. Again, you know, very very poor policy decision that will cost more billions of pounds, you know, outflowing from the UK and then going into the Middle East like Dubai and other countries who are more you know, forgiven for, you know, in terms of having stored wealth in those countries, which obviously, you know, if the wealthy run, that means you're going to get, you know, you're not going to get less tax. You're not going to get any tax from them, any tax revenue. And obviously that will put more pressure on the, you know, public healthcare. And yeah, I'm just not seeing good signs at all from the UK. I mean, what's your very quick perspective on the UK, you know, seeing what the recent, you know, recent speech by Reeves?
Absolutely shocking. I don't, it doesn't make any sense. I struggle, and this is saying something. The UK has been on a record-breaking run, torrid
Yeah.
pace of just weak government after weak government. And this current Labour government might be the most inept government that I've seen probably in my lifetime. It's maybe, you know, going as far back as my memory stretches, this is the worst administration I've ever seen. It's insane. If I didn't know better, the entire administration is being paid by some foreign state agent to basically destroy the UK from within. It makes no
Yeah.
sense. I'm
Yeah.
sorry, but wealthy people are the best thing that a country can have because they're the ones who have companies, they're the ones that have businesses, they're the ones that employ people.
Yeah.
And it just does not it does not make any sense to me other than the fact that the UK is clinging to this sad, pathetic, woke ideology that is going to destroy the nation. It's absolutely insane. I see it on a social front, I see it on an economic front, I see it on a governance front.
Yeah.
It's absolutely disgusting. And if I was English, I would be absolutely outraged at the state of the country.
Yeah, it's really not going in the right direction, and yeah, this work mindset is essentially festered itself not into just politics, right? And you know, people going out there on the street and protesting about just the most craziest things out there, but it also festered itself into businesses. You know, a quick story. I remember, you know, working for a Nasdaq business. During the Biden era. And essentially, you know, one of the key things that we were hiring for a head of marketing role. And I just remember, you know, one of the HR directors told me, the three candidates that I've presented, you know, she said to me, "Why are there no women? Why are they all white males? I want women in the shortlist." And I was like, these are the best people I've presented to you. And yeah, she wasn't having it at all. In the end, they've hired a white male, shock horror. Um, but you know, it just shows that this mindset of, you know, at any cost, you know, pushing the DEI, so on and so forth, it's getting worse and worse. And yeah, you know, it's hiring over the, you know, quality, right? You're not hiring the best, you're hiring to, you know, tick a box within you know, the DI sphere, which is crazy to me. And it's starting to show, right? And starting to show in productivity of businesses. It's starting to show in earnings. It's showing that, hey, we're no longer hiring the right people with the right skill set. We're just hiring for the sake of, box ticking exercise. And the US was going in that direction as well. I think another, 4 years of Democrats, and we would have probably had the same situation that we've got in the UK right now. But yeah, fortunately, it was it was saved, dependent on how you view the current administration, right? Because it's not without its faults. But yeah, moving swiftly on from the UK and then depression. The European side, listen, Germany is just as bad a situation as the UK, in my opinion, in some case worse. Once the manufacturing empire alongside the UK is really crumbling, the earnings from Ferrari and Volkswagen have been pretty terrible. Misses across the board, and talking about plants shutting down, so on and so forth. Obviously, the only stronghold that Germany has right now is defense manufacturing, like Rheinmetall and a few others. That's essentially holding the German economy. But for how long? If the Ukraine and Russia war, is resolved, then yeah, that's literally the last stand for Germany before we see a pretty rapid recession. I mean, have you got a different view to what's happening in Germany at all? Given the data.
Germany is doomed. Germany is doomed.
Yeah.
There is no hope. Germany, I
Yes.
like I don't want to sound so pessimistic, right? And
No.
but and there are parts of the world that are bright spots. Europe generally is not one of them.
No.
The countries, the continent, sorry, largely speaking, is on the wrong track, and there isn't much that can be done to reverse it. I don't, if you want bold predictions, I don't think the EU is long for this world. I think we're going to see a dissolution of the EU, and if the EU does remain, it's not going to look the same way that it does right now, and we're going to see the power shift from Germany to France. But yeah, Germany is screwed, and there's nothing they can do about it. They're terminal, and they're dead and dying, and maybe they know it, maybe they don't, but there's nothing that can bring them back to life.
Yeah. And even France, to be fair, you've seen the last few governments collapse within months. Massive turmoil in terms of what's happening behind the scenes. Listen, if the right party comes in France, and maybe they can turn things around. They got a relatively, smaller economy compared to Germany. Don't get me wrong, but per capita, they've got more of a potential to rebound, for sure. Germany will have to go through the complete country restructure, whereas France has got not just great manufacturing businesses, but also they have great services. Hospitality and leisure is fantastic there. So yeah, they've got a lot to offer. But yeah, you're just
They
gonna have
also
to
have a
see what happens.
demographic boon
Yes.
on their side. That the
Yeah.
French population is actually increasing, unlike the German population. Well, I mean, the Germans are trying to compensate for that with immigration, but they can't integrate the influx of immigration that they're self-imposing in a manner that's going to ultimately result in a net benefit for the country. Now, like the only political thing that I'll say here is that you're seeing, broadly speaking, a shift towards hard right nationalism in
Yeah.
Europe. And certainly, like that was the case with Italy. It's absolutely going to be the case for France. The question for France is whether Macron is going to see out the remainder of his term or not. That's really the question.
Yeah.
But regardless of whether he ends up seeing out his term or not, you're going to see that shift. And you have to ask yourself why, because that's not necessarily a good thing. I'm not pro hard right nationalism necessarily. It's generally not a good thing. And if you want the poster child for how things can go wrong when you go hard right nationalism, sorry Germans for picking on you, but you don't have to look much further than Germany. And
Yeah.
the scary thing, I think it's something that's largely inevitable. This is
Yeah.
cyclical. This is part of what human civilization has looked like for, since civilization began. So what can you do? The best thing to do is to prepare and be ready for these things. But to think that we can avoid it, I don't think so. I think the car is careening towards the edge of the precipice. The brakes are cut. It's just a matter of how long it takes to go over the edge. Again, I don't mean to sound so pessimistic. There are bright spots and there are ways through this, but I think we're going to see things get a lot uglier before they get better.
No, I agree. And listen, I think in the last three episodes, if you haven't worked out, both me and Imre are perma bears in this market. Don't get me wrong, charts are one thing, but the view of the world, we share very much the same concept that I still believe it is going to get much worse before it gets better. And the next 10 years will definitely show that. Um, oh, on Tuesday, something that was very interesting was the power speech, and probably the most important part was of his all typical gibberish that he likes to talk about, dual mandate, yada yada yada. And the really interesting part was in reduction of the balance sheet, as people know, quantitative tightening, and essentially what he basically said in between the words of being essentially an AI robot at this point, is essentially he said that the end of the potential end of quantitative tightening is going to happen by the end of the year. And what that usually means is, very simple terms, is welcome to more money printing, essentially. More money printing and pushing liquidity into the market. Simple terms. Obviously, there's a lot more nuance when it comes to that, but yeah, that's essentially what it means. So yeah, he's going to open the floodgates sooner or later. How will that impact, for example, yields and the market? Yeah, that's going to be very interesting to see once that does actually happen. But yeah, I mean, what did you think? Did you listen to Powell's speech at all?
You know, I didn't listen to the whole thing because it was very obvious where it was going. And here's the problem. The US, and this is this is the problem with all reserve currencies and with fiat with fiat currency in particular. Have you heard of the Triffin dilemma or the Triffin paradox?
No, I haven't.
Okay, so it's a phenomenal financial theory, and the simple term is that it's when a country gains reserve currency status, there's inevitably going to be a conflict of economic interests that's going to pop up between, say, the domestic concerns of that country and long-term, broader global interests and objectives for the countries who are forced to, hold reserves of that reserve currency. There's inevitably going to be a showdown. And why is that? Well, it's because the U.S. will have to continuously devalue its currency,
Yeah,
and that is going to be a frustrating thing for other nations that want to do trade with the U.S. So when you go from a creditor to a debtor nation, it just it just kind of sets you on this inevitable path, and COVID has been the accelerant, if you will,
yeah,
that's just poured gasoline all over this fire, right? And we can see how the money supply has just obscenely exploded since then.
yeah,
And there is no choice. What can the U.S. do? The Fed is in a bad spot, and
yeah,
people, you can bash Powell all you want. It doesn't matter who the chairperson of the Fed is or will be. It doesn't matter if it's a Trump mouthpiece. It doesn't matter if it's Powell. It doesn't matter who it is. The end result is inevitably going to be the same.
yeah. I agree. Until something changes, yeah. We are on a path, and I'll share a few charts in a moment. Just have to go through the final pieces of important data. I mean, the only part on Wednesday. very, very quickly. CPI. Yeah, China's in deflation mode at the moment. They're trying the hardest. I mean, you look at from the M2 money supply, 8.4% is obscene. In terms of how much money is circulating, in terms of year over year, it's the numbers are absolutely frightening. Which usually, if you see those kind of numbers, especially on the M2, usually that means M3 and M4. That there's going to be much more spending, so on and so forth. But we're not seeing that. So that the money that's circulating throughout the economy is not being spent by the consumers. And again, it just shows with the CPI being at minus 0.3% year over year. And I think we we are seeing what's happening in China right now, what we're going to see in the US. I mean, do you have a different view? Do you think we're going to go completely the opposite direction, or is that going to be, the US final destination? Is that deflation?
Yeah, yeah, that is the final destination, and I've been wrong in terms just being fully transparent. I've been wrong in terms of how quickly we'd get there. I really thought that 2020 was going to spur us towards that path a lot more quickly, right as bonds collapsed, and
Yeah,
then we saw money printing the likes of which we've never seen before.
yeah.
So I was wrong about it then, and eventually, sure, I'll be right. Uh, right? Even a broken clock is right at least
Yep.
once a day, but twice a day. But the the thing is, right? It's the timing I'm unsure of. I do think we're going to see a moderation in yields before we get a surge. But I do think that surge in yields is coming, and that's kind of the chart-based indicator you can look at if you want. Look at the U.S. 10-year yield, look at the 30-year yield, look at the short-dated yields, and when those are starting to explode and we get this crazy inversion, ooh, that's probably your canary in the coal mine.
Yeah, no, I completely agree. So yeah, we'll very quickly discuss yields as we get into the charts, but yeah, it's not looking pretty. I mean, apart from that, everything else into the data Wednesday wasn't that interesting. I mean, Thursday again, the weakening of employment is happening across the world. Australia isn't. Hasn't been saved, unfortunately. The unemployment rate has risen to 4.5% from 4.3, which is, I think a pretty decent increase. Usually, if we see this kind of increase and inflation for Australia is staying at that 3%, 3.5%, yeah, it's the early signs of typical, as we call it, stagflation, right? But yeah, I mean, very quickly on Australia numbers, does it shock you at all seeing those numbers?
No, I don't think it shocks me. It's just, yeah, no, it doesn't shock me. I think what's interesting is that Australia w- Australia is so heavily influenced by China,
Yeah,
just in terms of economic fortunes, right? So
mm,
that it's going to be interesting to watch how that develops. Could there be a tremendous amount of demand for what Australia exports? Yeah, certainly. I mean, there is
yeah,
tremendous demand. Whether that's enough to spur, hiring and all this stuff, I don't know, because although Australia, known for its commodity exports, still has over the years developed a mighty financial services industry of its own,
yeah,
right? And I haven't looked into the data as closely as you have, but I would imagine that it's the services industry that's getting hammered.
yeah. You're basically spot on. It's where most of the unemployment is happening. It's in the services. But everywhere else, I mean, mining is absolutely booming, and we'll get into gold in a second, because I think both me and you were yeah, pretty surprised by the move on gold. But But yeah, and what we are seeing in terms of retail buying, it's pretty insane. But yeah, from the data, apart from that, nothing really else that's sort of really showing anything apart from crude oil stock, massive increases in in stock of oil, of crude oil. So I usually like to see this kind of inventory build up for multiple weeks to potentially even multiple months before I make a decision, because depending on there are a lot of factors, seasonality, top of the month, top of the week. Yeah, it can fluctuate. So I like to see a really strong pattern building, on cumulative months rather than just 1 week. And there's loads of stock. The next week it's a drawdown, and yeah, don't really pay much attention to that at all. And then Friday's today. And yeah, we're not really getting anything. I mean, yeah, CPI year over year is steadily at 2.4%, which is we're within the EU's margin. Basically, they've given up at the inflation of 2% or below. We've discussed this previously. Yeah, the 2% is just a bunch of waffle. No backing of whatsoever to how they came to that number. So yeah, it is what it is in terms of Europe in that regard. Yeah. So I mean, the stories of the week or the last week and a half has been Jeffries. I mean, have you, dug into the story at all? Have you done any reading of what happened, or not?
Yeah, of course. It's the one thing that's very different as a Canadian, one of the biggest differences in terms of our financial system and what the US has is how much more conservative the Canadian financial system is. There's a lot more, I think, enforcement of regulatory action and oversight, and we have far fewer banks. Like I can count on the fingers of one hand how many like major banks we have. We only have two GSIPs, like banks that are so important to the global financial order that they have this special status, right? And when you have this network of regional banks the way the US has, it's almost inevitable that you're going to have bad loans pop up, and different banks have different risk tolerance levels. They have different ways they can play funny games with accounting. I mean, we all remember Silvergate. So is this surprising? No, I'm not surprised in the least. Did I have it on my bingo card for October? Also no. So the timing is tricky, but this
Yeah.
isn't shocking in any way. I don't think anyone that I would take seriously, with in terms of their macro analysis, would say they're shocked by this.
Yeah, no, and I'm not as well. As US is known for its subprime lending. Welcome back to 2008. Layman's, yeah, complete disaster in terms of subprime mortgage lending. We're basically getting a version 2.0. This time it's spreading, to auto loans, which I think it's a little bit more dangerous. The reason being is auto loans tend to be at a much higher APR, and the cascading effect can be a lot faster than mortgage delinquencies, car delinquencies. Even happens, right? The last thing you want to get rid of is your house. The first thing that's usually is going is cars, right? Cars and luxuries. If you can survive without a car, yeah, it's going. So I dug a little bit on the Jeffries balance sheet, on X, just seeing a couple of posts. And yeah, there was a lot of allegedly, quote unquote, and I have to say this as a premise, a lot of fibbing when it comes to balance sheets, and providing information to to the prime lenders about what's really happening at Jeffries. I think there is unaccounted 4.3 billion dollars that's just vanished. Essentially, no, there is no explanation to how that money's missing, which sent just a panic shockwave across the KRE, which is regional banks ETF, dropped nearly 10% in 2 days, which just been absolutely insane. And yes, granted, some regional banks have managed to bounce back, because today literally we had Deutsche Bank and JP Morgan come out and say, listen, we there shouldn't be any worry, we've got ample of credit going on. Yeah, I tend to not to believe those guys, especially Deutsche Bank. But yeah, they've calmed the markets a little bit. So the KRE is currently having a little bit of a rebound, but yeah, crazy, crazy. What's happening. Yeah, I mean, what are your thoughts on regionals? Just very, very quickly. Have you got an opinion on them?
Yeah, I think that they're
Yeah,
or at least play like color slightly outside the lines, let's say, and get creative with their reporting. And these things usually are like, oh my goodness, how could we have missed this? Like it's so obvious with the benefit of hindsight, but it always seems to take the world by surprise when it actually hits. Uh, Other than regional banks, I'll just an interesting. I don't want to. I'm not going to get the statistic exactly right, but in America, people buy a new car like on average every 3.5 years or something like that, which is absolutely insane. And Americans, for an absolutely idiotic reason, have an aversion to leasing cars. If you are going to get a new car every 3.5, 4 years, you're either buying supercars, which may even increase in value, and I can tell you that's not what the average American is doing. Or you are buying cars or financing cars, so you have this idea that it's my car, I own it. But then I end up in this negative equity situation, which is where when I want a new car in 3.5, 4 years, and the car is worth less than what I paid for it, but I still owe that original value on the car, I go to my dealership, and the dealership is going to say, no problem. We can make that go away for you. Except they can't make it go away. They just roll that negative equity payment into your next vehicle. And now you are
yeah,
perpetually underwater on a depreciating asset, which is like the dumbest, one of the absolute stupidest, most moronic financial decisions that anyone can make. So if you're American and you're listening to this and you want to get a new car every 3 to 4 years, lease the damn thing. And guess what? Consider very strongly whether or not you're in a financial position where that even makes any sense in the first place. So this
yeah,
is very much a self-imposed materialistic problem.
yeah,
And I have very little sympathy. I've empathy for sure because I think the finances around this are misleading and dealerships play
yeah,
shell games, et cetera, et cetera. But
yeah,
just a word of personal like this is not advice, of course. It's just common sense in my opinion.
yeah,
You don't need a new car every 3 4 years. You just don't. And if you do, lease it.
yeah,
Lease it so that you're protected from the negative equity. It's a
yeah,
no-brainer.
yeah. I mean, pretty much spot on. Everyone wants to have a great new car, don't get me wrong, but yeah, if you're going to put yourself in extreme financial turmoil because the seats are, the design has changed, or the front grille is a little bit nicer, and you're paying a 50, 60, $70,000 premium for that. Yeah, it's a little bit crazy. I mean, just to very quickly, to add to what you've said, right? People just believe that, hey, because regional banks are struggling with this, as you can see on this particular news article, exposed to 715 million in collapse in first brand's debt. The fallout, what it means is because banks work on what's called fractional banking. So whatever money you deposit into the bank, they don't actually hold 100% of the amount. They hold about 10%. 90% is then lent out to other people that are looking for loans, so on and so forth. So essentially, I call it one of the biggest legal Ponzi's there is, essentially. But the run on banks that happened in 2023, Silicon Valley Bank and a few others. Essentially, people wanted to withdraw money, but they physically couldn't, because either SVG had money locked in bonds, or the money was lent out to other banks. And essentially, what that caused is for them to sell their bonds at extreme cheap prices, because they had to facilitate, um, you know, people getting the deposits out and the money out. And that's essentially, caused cascade where, FDRC had to get in and essentially bailed them out, and then JP Morgan and Bank of America essentially bought those banks out or bought their debt out in order to save the economy, because that fallout was going to be absolutely insane. And right now, FDIC hasn't got the cushion that it had in 2023. So if we're going to have a similar scenario, yeah, we're in big trouble. But yeah, just very quickly on money and to supply. We've discussed this with the data. Yeah, money is getting printed. Nothing's stopping it. Um, and then November is going to have the same sort of mark. And yeah, you can sort of see it. The money supply, the M2, in line with the stock market. It's pretty much in tandem, right? Whenever money supply grows, the stock market grows, and then vice versa. We had separate occasions where it was a little bit lagging, but yeah, overall sticks the same. Um, Gold futures, we'll discuss that a little bit later. But yeah, I mean, in terms of regional banking, you can sort of see what the bloodbath that happened yesterday. 6.2%. It's getting a little bit of a rebound, as I said, because of Deutsche Bank and JP Morgan are trying to hold the line. But yeah, it's not looking pretty. I think we're going to see April lows of 2023 very shortly. I mean, do you think we're going to see the same lows that we saw in 2023, or do you think KRE is going to be saved?
That's a good question. I hadn't looked at KRE, frankly, really since 2023. Like, it's never something that I would want to invest in. And I'm not, I promise I'm not making this up, but I had these like lines on my chart, and I like traced like a very rough path on what I thought KRE was going to do, and it did exactly what I thought it was going to do, which is, again, kind of cool, like whatever. But the point I'm trying to make here is that according to my line, which was really just drawn rough and I didn't like measure anything else, we are gonna have a drop here, but it might not take out the lows um, from 2023, let alone the lows from April of this year. So I'm not entirely sure on that. It's not a chart I've spent enough time to analyze, frankly, but
Yeah.
yeah, I'd be surprised if we saw a complete collapse at this stage of the cycle. I think we will get a collapse in regional banks a little bit later in the cycle.
Yeah, well, just by the way, just sharing your screen very quickly. They can see your charts right now. So, um, yeah,
Oh,
I'll just,
okay. All right.
I'll just flick back and
Yeah,
forth.
let me go
Just
back to.
tell me when, and yeah, I'll flick back to your screen. No problem at all. So,
All right. Now, I,
um,
I just saw a note of the time. I'm gonna have to run a few minutes before
yeah,
the market open, because I do expect it to be a lively one. But yeah, if we wanted to go over charts, I'm happy to go over a couple of
yeah,
things.
yeah. So let's your screen's online already. So yeah,
Is it
floor is
up?
yours.
Yeah. Okay. All right. Cool. Let's do the big one, which is gold, right? Like I think gold is something that a lot of people are very interested in for good reason. So one of the things with gold, and let me punch this up a little bit. A lot of people, right, will talk about a trend in terms of like higher highs and higher lows. That's a price-based definition of a trend when you have a series of swing points moving in the same direction. From an order flow volume perspective, which I would argue is more important, and then we go to price action second. You want to see value shifting continuously higher. And if you don't know what this is, ask me on Twitter. I'm happy to like help you out, whatever you want. But what we're seeing here is a migration of value higher. We see these value areas, right? These like little gray lines. These are areas of value continuously migrating to the upside. When is the trend in gold going to be over? And we are in the blow off top stage. Like, I'm very, very confident that we're in the blow off top stage. I don't have a position short yet. Why? Because what I'm waiting for is value to stop migrating upwards. And what that's going to look like is we're going to see these gray lines start to go lower, and maybe they'll go sideways for a bit first and then they'll go lower. So an example of that would be this very quick little mini correction. Value migrated lower for literally just a day. literally a day. If we had a second day of lower value migration, I would have started to press the market perhaps a little bit, but we don't have that. And then we have sideways value, which is when the market is in a balanced state. Now you contrast that, we're going to now switch over to the S&P 500. You contrast that with the S&P 500, and we're going to go find like a bit of a bearish situation here. We can go to April. Notice how the trend, a value perspective, went from being incredibly balanced here, where we see even from afar, the value area is just going sideways. Now, from a price action standpoint, we know what that looks like. It's going to be a range with price bars with long wicks on either side. And then what happens is as the value starts to migrate lower and lower and lower and lower, the price action follows suit. So remember that price is a consequence of volume, right? So that's why I like to look at volume first. So if we're looking at the S&P right now, let me just go to an MES chart just because it's should be clean. There we go. Now it's clean. We can see that we have a large move lower here. Value has migrated lower. And what's happened since then? You know, we've had this kind of choppy back and forth, and we'll have to wait and see what happens today, right? So here on this pullback, value migrated lower. When was the pullback over? When value started to migrate higher, right? So if I'm looking at it like this, and if we do start to migrate lower in value, we're going to seek fair value. We're going to seek an area in the market where buyers and sellers are equally happy to transact. Now, the first obvious area that would be where we balanced back in August. Okay, this entire region here is where the market was happy to do business. And then eventually we decided to move out of balance into a state of imbalance in search of discovery of new fair prices. Okay, so what we have here, and we can see even just looking at these volume profiles or these session profiles, from a price action perspective, a classical chartist would just look at this and say, oh, we've got, you know, two shoulders and a head. Now, here's the interesting commentary I have on chart patterns as it relates to order flow analysis. It's not that chart patterns like triangles and head and shoulder patterns and rounding bottoms and cup and handles, it's not that they don't work. All right, as an order flow analyst first, I don't dismiss classical chart patterns. It's just understanding the context in which they take shape. If we have a head and shoulders pattern and value migrates sharply lower as we break the neckline, that tells me that this is a pattern worth looking at. Okay, so just keep that in mind. But this broad range, right, will span, and we can take a look at a candlestick chart here. You know, we can see that this is a very broad range here.
Yeah,
we're talking about in August, right? But I do think, you know, if we do start breaking lower here, we're going to look at the 6,500s and lower, and that's going to put people in a lot of pain. And I think it would be very, very healthy for the market. Now,
yeah,
if I wanted to do some other price-based like fib measurement stuff, I can look at the swing between these prices and see if there's a relationship there that makes sense. So we can see that where a swing lower would equal in points, the first swing would be down at 64.96. Just but things want to get a little crazy, we can look at the 6400s, we can look at the 6335s. All right, so right now from a price-based perspective, those are kind of the areas I'd be looking for. But just going back to this volume profile chart, do we have a defined downtrend right now? No, we don't. Right now we don't. Right now we're very much in a state of balance. This is where we've previously agreed on fair value, and the market is going to remain in a state of balance until it doesn't. How do you know when it doesn't? It's going to be very clear. It's going to be very clear because when price moves out of balance, it can only do one of two things. It's either going to, and we see this right here, we see this selling tail right here. We see the selling tail, we see the selling tail. We tried to move out of balance, and the buyer said, you know what? No, we actually still think that these are cheap enough prices for us to buy at quote unquote wholesale, right? Retail is buying here. They're buying the breakout. Wholesale is thinking, well, you know, this is still an attractive price. We still believe this is fair value for the market, right? But we don't think that this is fair value for the market. Sellers said, you know what? These are pretty expensive prices. We're happy to sell here. Right. So right now we're still in a state of balance. What we need to see is value, the value area, firmly shift outside of balance. Once we have the value area firmly shift outside of balance, that's when I'm going to get excited from a trend trader's perspective. So just taking a quick look at the intraday stuff right now, and that's why I say, like, look, these maps that I make that pretty much are bang on every single day, it's not a special skill that I have. It's not because I'm so much smarter than everybody else. It has nothing to do with that. It has simply to do with identifying high probability areas where I think buyers will be responsive and sellers will be responsive. And if buyers want to press, or if sellers want to press, I'm going to look for those levels too. Again, there's nothing magic about it. Anyone can learn to do this. It would take you probably a couple months. That's it. So this is not a special skill. I'm not some market savant. I'm just looking at very, very obvious levels. Okay. But what I'm looking at right now is very, very interesting. We have my control pivot level, where if we take that out and can claim it with what I call strong initiative behavior, i.e. intraday value being accepted above the control pivot level, that opens the door to my collection of upside targets. But you can see right now, we're trying to test it and we're rejecting it right now. Cash market opens in a minute 20. We're going to then see possibly a rotation back towards the pivot apex. The pivot apex, if that breaks, we can open the door back to our downside targets. Last downside target of the day at 65.40 and a quarter points has not yet been hit. Is that on the cards? I have no idea. The last thing I'm going to mention, however, is you see the blue lines here. Those are the developing value area high and low over the
Yeah.
last 5 days. And look what happened. We tried to make a run for it. We tried to make a run outside of value. We succeeded. And then buyers said, wholesale, thank you, cheap prices. Fine, you can point to the leak of the Fox News interview. I don't care. We're now back within the value area. We're now back within balance, right?
Yeah.
So now we have to see if we can migrate back outside of the value area. I think that would be a big blow for bulls. But right now, I think you have to give the bulls the benefit of the doubt and see how well they defend the value area low. I think this is a fair bet that we're going to test that from a scalper's perspective. And I'm happy to hang out for the next few seconds here, and we can see how the market's going to react on the cash open. And if we don't, then I'm very curious to see how we react at the control pivot level. Okay, so what I'm very, very interested in seeing is, again, how the auction is going to respond to the pivot apex, the value area low, the control pivot level, the point of control at 66.93 over the last 5 days. Those are the levels that I'm most keen on right now. And
Yeah.
what I don't necessarily want to do from a trader's perspective, if I'm scalping, if I'm day trading for the day, I'm not trying to front run these levels. I'm not just blindly shorting now because I think we're going to hit 60, what is that, 66.42. I want to
Yeah.
wait to see how we react at that level, right? I want to see I want to look for reactions, and I want to trade those reactions to the edges of value. You've heard me say this over and over again on Twitter. I'm curious on how we trade at the edges of value. This is the edge of value. This is the edge of value. This is the edge of value, right? And when you are patient enough, or even have the knowledge of knowing what the edge of value looks like, being able to construct trade setups with asymmetric reward to risk parameters, where you're risking 3 points to make 9, or whatever the case might be, your odds of hitting those trades increases exponentially. Okay, so it's the beauty with order flow analysis. It's not that order flow analysis and auction market theory is the holy grail. To me, the holy grail is understanding where to look for asymmetric reward to risk opportunities that have a better than a coin flip's chance of working out.
Yeah. No, completely
All
makes
right,
sense.
rant over.
No, no, no. Thank you very much for giving us a little bit of an insight from your point of view, and how you're seeing the market. And a lot of the times, especially in the retail world, you get this almost like a fantasy from a psychological perspective that all the news is bad. The world's falling apart. Therefore, we must go lower by that definition. And unfortunately, that in a lot of the cases that doesn't happen, which which is why over 85% of retail traders lose. Is because once the bias sets in, it's extremely difficult to get out of it. And just as an add-on in terms of obviously your levels that you've shown, my interest lies in your execution, right? So you've mentioned you're waiting until those levels hit, potentially to then react to the market, looking on an intraday basis. How do you how do you know when to execute at the right time? Is it purely through risk management when the level hits? Is it through confirmation, where the price hit that level multiple times and rejected it? Yeah, how do you calculate your entries on an intraday basis?
Yeah, that's a great question. So this is a very, obviously this is a topic I should talk about for hours, not just a quick minute here or so. But we've
Yeah,
got to I can go over this one. So we're on TradingView right now. TradingView, admittedly, is not the best tool for this particular um, view of the market, but TradingView does have a tool called a volume footprint. It's not real volume footprint, it's more tick-based volume. If you have questions on what that means, we can get into it. But what a volume footprint does is it gives you an X-ray look at a price bar. So
yeah,
now, instead of just seeing a price bar, I can see the makeup of that price bar. I can see who is behind that price bar. I can see if there was real aggression behind a big bullish bar or behind a big sellish bar, selling bar. I can see if sellers are getting absorbed and exhausted. I can see if buyers are being, um, absorbed and exhausted. If you're only looking at regular candlesticks, that's like trying to win a boxing match with a blindfold over your eyes, and one hand tied behind your back. You're just not giving yourself the best chances of success. Whereas a volume footprint really allows you to be on even footing with how the professionals are really looking at the market. So I'll give you an example. We can see here in the overnights, well, in the Globex session, we can see how the market here broke below the pivot apex, came back, retested it, and then sold off strongly. Now I was fast asleep at this time. All right, so this is not me trying to tell you how I would trade it in hindsight, but it's what are the signatures that we're looking for. I'm going to zoom out because we don't need to see everything on the volume footprint, but you'll notice that there's a white square on these price bars. That white square is the point of control of the price bar itself. It's where in that candlestick the most volume was traded. Now, what I'm looking for at a key level is how the candle closes relative to that point of control. Now, if the candle, and we're looking for a bearish reaction from this pivot apex level, then I'd be looking for price bars to start closing below their points of control. And if you get that, you have a very, very high probability entry point with really good risk reward behind it as well in terms of being able to find that entry that you like. So another thing I like doing is profiling individual legs. So if I'm profiling an individual leg, instead of having a macro view, I can look at the value area of the entire leg itself. Now, my favorite entries are in a bearish, if I'm looking for a bearish trade, I want to see a rejection of the value area high of this profile. And I like to add on confirmation as we break with initiative, strong selling behavior below the value area low of the profile. That's telling me that the value of the auction is fundamentally shifting. Now, if we take a quick look at where we are right now, we can see I'm going to do two things. I'm going to profile this most recent leg right here, and we can see that we broke below the value area low. And now we're doing what's called a break in, where we're breaking back above that value area low. This
yeah,
tells me that this is a failed auction by bears, and we're likely headed higher now. Likely. But what I also then want to do is profile the leg lower and see if we've broken in on that leg lower. We
yeah,
have. But look at where the auction is stalling right now. It's stalling right at the value area high here. So for bulls to really get going, we need to see strong initiative behavior. So I'm always looking at the market from the perspective of what's called Bayesian thinking. Bayesian thinking is just a fancy term for saying that I think everything is possible. Everything's possible, but my focus on trading is on trading what's probable, what's most likely to happen. Now, the Bayesian part of it is that I'm constantly in my head updating what's more or less likely to happen based on new information coming in. So right
Yeah.
now, we're rejecting that value area high right this second. That tells me that on the Bayesian scale, sellers will be in control if they can continue pressing. However, moment by moment, second by second, tick by tick, I can change that bias. The probability scale is always shifting back and forth, and you can see how buyers took control. We have strong initiative presence at the low of this price bar given by the green lines. And now we can see that we're trading higher towards that control pivot level. As we reach the control pivot level, it's going to become very important to see if sellers can step back in or not. And we can see just as we reach the control pivot level, or got very close to it, we can see absorption at the highs here. So I'm always shifting the probabilities back and forth, and I want to frame reward to risk opportunities around what is most likely to happen. That doesn't mean I have any degree of certainty. It's very rare that I'm almost on the far right side of Bayesian probability. I just want what's most likely to happen, and I want the
Yeah.
opportunity to earn more on a trade than I'm risking. So long as those factors line up, we have some magic on our hands, and we have the potential to have a fantastic trade.
Yeah, no, thank you very much for that explanation. I think that requires a further insight. I think next week, I think we should put at least 30 to 35 minutes of just explaining how the tick volumes formed, what it is, what's different compared to the actual real market volume, for example, that we see in the futures, right? When we get level two data availability through CME or the other gateways, that you're able to see how many shares are inputted into the market when it comes to stocks. Whereas obviously in regards to CFD, unfortunately we don't see that, but we do get some amazing close and amazing analytic tools like you've just shown with the volume footprint. I use a very similar one. It's just but instead of it being all lovely green and red lines, it just basically shows on the right hand side um who's currently quote unquote controlling the market. But as you've mentioned, it's not 100% accurate because, as I said, it's just more of a like a, I wouldn't call it a prediction tool, but like a historical calculation, based on and then trying to give you like a live scenario of what's happening on the market, which is definitely useful as a retailer for sure. So yeah, when is this particular footprint free, Imre, or do you have to pay for it?
It's a good question. I think you have to pay for it. I'm
Yeah.
honestly not sure.
Okay.
I think you do have to pay for it. So real quick, and then I'm sorry, I've got to jump.
Yeah,
I've got
yeah.
my
No, it's
my
fine.
team at the fund telling me they want to talk to me and ask me a few questions. But right,
Yeah,
right now we can see how this is a volume profile, right?
yeah.
And well, what are we doing? We are trying to break below the value area low there. And if we do, where are we going to go? We're going to go to the next area where the market previously agreed on fair value. And then we'll see what happens from there, right? So right now, this is an inflection point. And from a trader's perspective, I'm extremely interested in potentially taking a trade here. But notice I didn't say long or short because I don't like carrying a directional bias in that sense. I really want to wait to see how the auction reacts, and I want to simply go with who I think is winning the auction. And my trade can flip back and forth if I'm scalping. Like I could take a short now in anticipation of us breaking below value. But if we don't and sellers get absorbed very quickly, then what would I do? I would flip and become a buyer, right? So that's the beauty of scalping is you're going with the flow. If I'm doing more intraday swing trading, which is frankly my preferred style of trading, then I'm going to be very patient and I'm going to wait for that one really good trade of the day. Two, if we get what's called a value traverse, where we auction significantly higher or lower, then we have more or less a full reversal. Okay, but with that said, I'm sorry, Matt, I've got to jump. I don't even
No,
have time to wrap things up, but I'll be free on Twitter to answer any follow-up questions and look forward to seeing you guys next week.
Speak soon, Imre. Have a good one.
All right. Cheers. See ya.
Take care. Bye. Yeah. Listen, guys, just obviously, wrap up from my point of view. Yeah, it's been an absolute pleasure dealing with Imre again, and we are going to talk about it next week in a little bit more detail, going through volume, what it means on the CFD market. It's very much different to, as I say, the futures market. You don't get as many real insights as to the type of volume that's really happening in terms of how much buying there is, how much selling there is. But there are a lot of great indicators that are that you're able to get from that, which is obviously fantastic, and hopefully we can share it with you next week. But yeah, apart from that, thank you so much for